I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Jason Sen on the line. He's a technical analyst and director of DayTradeIdeas.com. He got his feet wet in the option pits on the trading floor of the LIFFE in 1987 at the age of 19 years old, making markets for its own account, and then he made a transition to the floor in 2001. Jason, how you doing today?
I'm great, thank you.
I always like to talk to people that were on the floor and made the transition from screaming and yelling in the pits to trading behind the screens. Was that something that took you a little bit of time, or was it something that you started out slow and you built it up to where you are today?
I took a little break from the floor and then I started screen trading. I think for options traders the transition wasn't quite as hard as it may have been for the futures traders, because for us, the maths sometimes was a little, well, I'm not saying that futures traders didn't have a lot of maths to do, of course they did, but when you're trying to hedge and figure out your deltas and all that kind of thing, and your gammas, then you have to do that quickly in your head. Obviously, it was a little bit easier when you're doing it on the screen. It was all computerized for you, and instead of running out the pit and running off new sheets on your computer to adjust your skews and your vol and everything else, that can be done instantly right in front of your face. Your option models built into your prices. So I guess in a way it was in some ways perhaps it was a little bit easier for option traders at least. However, when I tried to trade futures, I got to say I was a complete disaster to start with. I found it very difficult indeed.
And so what do you traded now? Are you sticking with the options? You trade a little bit of everything. What's your forte?
Well, I decided I wanted to stop trading options because as a market maker, you end up with this big book on so many different strikes in so many different months, and you're just married to the position. I never really managed to get flat, so every holiday, all I was doing was walking up and down the beach onto the office, finding out what was going on. So eventually I decided I was too old for that. I thought I'd get into futures trading. I thought it would be easy, and I found it very, very difficult indeed. None of the skills that I was using to trade options really I could use in futures. It's a completely different game, and I was completely lost. So after losing a fair old sum of money, I figured there's just no point in throwing more money at this. I better try and figure out how to do it. And that was really what brought me to technical analysis. It seemed like a way to try and get some sort of edge and figure out some sort of logic to the market.
And so what tenets of our analysis techniques do you like to follow? I know everyone has their different technical analysis patterns. What do you like to follow?
I keep it really simple. I use Fibonacci a lot. I think really Fibonacci is almost a lazy way to trade. You can quickly throw some fibs up there, and once you get in the habit of putting them in the right place, you can quickly identify support and resistance levels. So I find them very useful. I look at them across lots of different time frames. I keep it very simple. Trend lines, Fibonacci, moving averages, and obviously just looking at price action, candle formations, the usual chart patterns that seem to work fairly consistently, head and shoulders, double tops, double bottoms, that kind of thing.
The basic stuff. And so are you applying those to the stock index futures right now, or what are you currently trading?
Yeah, well, actually, for my clients, I cover about 25 markets. So every morning I do several hours of analysis to write a report for my bank clients and my retail clients. And then if I get time to trade it, and to be fair, I don't get time to trade every day, but if I do, then I'll just pick any of those. I'll just wait. I'll be writing a report and think, hey, this looks like a big opportunity. Like the bounce that we got on Thursday, I was looking for that bounce. I think any technical traders that were watching that and could see 3-year trend lines being approached, they would have seen the same thing as me and thought, hey, there's a good chance this is going to bottom out. So, so for example, I only did one trade last week, but I managed to catch the low on those stock indexes.
Oh, that's nice. So you said you do reports for bank clients and retail clients. So tell us about the different reports that you send.
Actually, they're the same. I started out by purely having bank clients, corporate clients. I did some time in a broking company, and I got introduced to some of these clients, and I gave this technical analysis a whirl. And starting out really, I didn't really have too much of an idea what I was doing, but it seemed to work, and the clients liked it. So when I left that company, I established a business, and I took some of those bank clients with me. And then about 2 years ago, I thought, hey, if this works for corporate clients, maybe it'll work for retail clients. So I kind of took the language down a couple of notches to try and make it more understandable to the man in the street. Because after having worked in financial markets all my life, a lot of you speak in that jargon, and of course not everyone understands it. So I had to make a transition and try and speak a little bit more clearly in my reports. But the reports that I send to the banks are exactly the same reports that my retail clients get now.
So the banks are interested in this day trading strategies and shorter term trading. I mean, are they using your analysis to get in and out of trades? I mean, you're kind of hoping that the banks have a little bit longer term perspective on things. How do they use your information?
Yeah, you're right. I don't think they're in and out of day trades like the retail traders are, but I think they like the levels. I think they find the levels useful. Maybe they're hedging, or maybe when they get a big order in and they need to hedge, they'll wait for one of the levels to pop up. So I think they use it as a guide. I don't think they're sitting there going, all right, this is a support level, let's buy in here with a 10-tick stop. They're just looking for the big levels for whatever business they're doing during the day.
Okay, so you talked about the activity from last week, and you used the trend lines to get in the trade. What were you just using a stop like at the lows from Wednesday and I believe it was Tuesday and Wednesday? Were you just trying to take a stab at that area and say, okay, if they take out for the lows of that 1813 low, I'm out? Did you have anything else to support your analysis? And then also, on the way up there, when it started to go, do you have a process for moving your stop up, or do you have specific targets on your trades?
Well, that particular trade wasn't quite as smooth as I made it sound. I was watching the S&P. That's my real favorite market. And there's a trend line going back to, I think, October 2011. And anyone can have a look on their chart and see that. I look at the E-mini S&P, and if you stick that trend line going back from October 2011 on your chart, you'll see it was a big support level. So I figured there was a good chance that we would hold there. But I didn't buy the S&P. I bought the DAX because I thought the DAX had come off way further, and I thought maybe that would get a really good bounce. And I nearly stopped myself out because the DAX continued lower on Friday morning when I bought it, and I thought, wow, I'm wrong here. But then I looked at the S&P. I thought, oh, what the heck? I'm just going to hold on, and literally by the skin of my teeth, I managed to hold on to the trade and caught the bounce. So perhaps it was a bit of luck thrown in there as well. But the S&P really did hold quite beautifully.
Did you hold this one overnight, or was this something for a day trade?
That was a day trade. Let me think now. Yeah, I bought that on the Friday morning, and I just held it till Friday night. And that was literally the only trade I did last week. I called this market lower. I mean, I know a lot of people did. It wasn't just me. From the charts, it was fairly clear that we were going to go down. But actually, the speed of it caught me out. I thought we were going to spend a lot of October building a right shoulder. I thought there was a head and shoulders pattern building in the S&P. The left shoulder was kind of built through the summer, and then I thought the head was built through August, September, and then I thought October we'd build the right shoulder, but I got that wrong. We came down way quicker than I expected, and I never even got a chance to get short into that.
And so what are you looking for now? I mean, we had just like 2 days, rally from the lower 1800s to the upper 1800s. I like to do my analysis. I'd like to use some fib, but I really like to use daily highs and lows and closes. And I was looking at the high from last Tuesday at 1892.75. Couldn't quite get there on Friday. 1891.75. I think also you have like the psychological $1,900 level too. You think we can get back into 1,900 on this run, or you think we got some more work to do on the downside?
Good question, and I know exactly what you mean. Yeah, I can see that high you're talking around. Was it Tuesday's high? I thought we could push higher again today, but it doesn't seem to be happening. I really thought that we bounced off such a good support level, and the price action was quite positive, especially on Friday. We had a good candle on Thursday and a good candle on Friday. I'm getting my days mixed up actually, aren't I? It was Thursday I did that trade and had to hold it overnight. So anyway, this is a big challenge, isn't it? That 1890 area, and then of course you've got the 200-day moving average around the psychological 1900 area. So I agree with you. That's a big barrier. We're going to have to get through there. I think we can. I think we can get through there. Maybe we just had to have a little pullback today and get a run up on it for later in the week. And I think we can push higher, but I don't think this is the start of a bull run. I think this is a bounce back in what will start to be a bear market. And I think if we get into the mid 1900 area, that would be a very nice selling opportunity. I think there's a good chance we'll turn lower from there.
And what about, like, we just had such a vacuum on Thursday and Friday here, and now we're starting to give it back. Shorts rethinking their position, longs that missed out are trying to get in. I like to use a couple intermediate numbers. I like to use a daily pivot. 74.50 in today's session, got below that. 1870 was Friday's intraday low, but those are just really minor numbers. I don't see any really major support until you get down to the 1850 level. 1850.50 was Thursday's close, and Friday's low at 1851. How do you find a support level if you had that violent up moves that we had on Thursday and Friday?
I've got the 1873 area as a decent support, and anyone can see that if you just throw some Fibonacci levels on your chart. If you take the all-time high around the 2022 area in the E-mini, and you take the low around the 1813 area, then actually no, what I'm looking at, sorry, is correct that 1968 was a high that we kind of took a sharp dump from in September.
Okay.
If you take that high of 1968 and a low of 1813, you just throw some Fibonacci levels on there.
Okay.
You've got a 38.2 at around 1873. And if you go even shorter term, you take the low of that 1813 area low and put it up to the bounce high on Friday, then you also get a 23.6% at 1873. So I think that overlapping Fibonacci, well, so far it's worked today. I don't know whether it'll hold for the rest of the day, but it's not a bad short-term area anyway. Maybe if you think that this is a decent bounce back and it's got legs for a few days, maybe that's a decent place to try and jump back in again.
Okay, so you'd like to rely on your fibs. What about what do you think about like a stock like IBM? Basically wrecking the market today. One stock, one earnings, no Ebola, and it's basically just the SPOOs were trading up in the pre-market. They were trading much higher last night. They pulled back. Boom. News comes out on IBM, and it's sinking the whole market. Is that part of your bearish thesis? Is that this market is just too dependent on one stock? What if Apple misses tonight? What the hell? Are we going to be down 200 S&P points?
Yeah, I guess we could do. I think it just shows you that sentiment is so different to what it was in the first 6-7 months of this year. We just kept going up, didn't matter what came out. Any talk of tapering, no matter what it was, we just kept going up every day, up. Now it's different. We are really listening to bad news. It is having an effect. We're struggling to hold on to gains. I think this is a developing bear trend. I really don't like the look of this stock market in the weeks and months ahead, and I'm quite frightened as to what could happen next year. I really think that this is a bear trend that's going to have some legs and going to last for a while.
Okay.
I've got 2008 in the back of my head and thinking, are we going to see a repeat of that? To be honest with you.
Ooh, really? That's what similarities are you seeing?
I'm not seeing anything massively similar pattern-wise. I just don't have a good feeling about it. I guess that's more gut feeling than what I'm seeing on the charts. But we'll have to see how this develops. So far, all we've seen is a correction. So for me to be saying this is definitely going to be a bear trend, it would be way too premature. We'll have to. It's just my hunch. I think this is the start of a bear trend. And
Okay.
this is the first time we've seen the E-mini get below the 200-day moving average for a long time, and we've seen that this month. I think that's something that's worth paying attention to. There's a few other little things that we should probably be wary of.
Okay, well, you're talking down the market right now. S&Ps have just made a new intraday low here, pre-market low 1872.75, trying to hold that level. We do have the intraday low from Friday at 1870. We'll see if we can get a little bounce off that. Before I let you go, you deal with new traders and veteran traders alike. What are, just for people that are just getting started, what are the common mistakes or common traps that new traders fall into?
Oh, I've made them all. I've made all the mistakes many times over. I think one of the key things is it doesn't matter how big your account or how small your account, you've got to trade. You've only got to trade a very small amount on each trade. Trade exactly the same amount on each trade. You never know which trade's going to work, which trade isn't. I made that mistake before by seeing something on the chart and thinking, oh, this trade's definitely going to work. I'll put more money on this one, and that didn't work. And then the one that you think, I don't think this trade's going to do too well, but it's worth a try. I'll just put a tiny amount on, and that one works really well. So I think the key is just controlling that money and making sure you stay in the game. Just trade the same size on every trade.
Yeah, using caution. We have Jason Sen on the line. He's a technical analyst and director of daytradeideas.com, sharing his thoughts on the market and his strategies for this volatile market. Jason, thanks a lot for coming on. Hope you have a good trading day and hope to speak to you again soon.
Thanks, great. Really enjoyed it. Appreciate it. Thank you.